Return on investment is a simple ratio that divides an investment's net profit or loss by its cost. Because it is given as a percentage, you can use it to compare how well an investment is doing. Today, in this video, you will learn about what return on investment or ROI is and why you need to know ROI before investing in 2023. Stay until the end of this video because if you are planning to invest in the stock market, return on investment is very important for you to understand. Understanding ROI can help investors set realistic goals for how profitable their assets will be and change their investment plans as needed. So without wasting any time, let's start the video. What is ROI and how to calculate it? ROI stands for Return on Investment. ROI is a way to measure how profitable an investment is. It is usually expressed as a percentage and is calculated by dividing the net profit of an investment by the cost of making it in the first place. ROI is a way for investors to figure out how well their investments are doing and whether or not they're making money. Investors might compare the ROIs of different assets to see which makes the most money. For example, if you put 100 rupees into a stock and it goes up in price by 10 rupees, your net profit is 10 rupees. If you sell the stock, your net profit on investment is 10%. Here's how to figure it out. ROI can be calculated for stocks, bonds, real estate, and other investments. It is an excellent way to compare how well different investments did because it considers how much money was invested and how much money was made. This was all for what is ROI and how it works. Now let's take a look at an even more exciting topic. That is, factors that affect ROI. There are several high alert factors that can affect the ROI of an investment. Some of the most important factors to consider include: number 1, investment risk. Higher risk investments tend to have the potential for higher returns, but they also have a greater chance of loss. Number 2, investment horizon. The longer an investment is held, the more time it has to grow and generate returns. Investment fees. Some investments, such as mutual funds and exchange-traded funds, charge fees that can reduce the overall return on the investment. Economic conditions. The state of the economy can have a significant impact on the ROI of an investment. For example, during economic growth, stock prices tend to rise, which can lead to higher returns for investors. And investment diversification. Diversifying an investment portfolio across a range of asset classes can help to mitigate risk and improve overall returns. By considering these factors, investors can make more informed decisions about where to allocate their funds to maximize their ROI. Methods used for measuring ROI. The return on investment can be evaluated with the use of financial ratios like the price-to-earnings ratio and the price-to-book value ratio, as well as more complex methods like the discounted cash flow analysis. However, it is important to consider these factors in the context of the specific investment being evaluated and the investor's goals. The price-to-earnings ratio. One common financial ratio used to determine a company's worth is the price-to-earnings ratio. An investment's return is determined by dividing its market price by its earnings per share. For example, if a company has a market price of $50 and earnings per share of $5, its PE ratio is 10. The stock market's valuation is often discussed in terms of the price-to-earnings ratio. If the PE ratio of a firm is high, then the company may be overvalued, whereas if it is low, it may be undervalued. The PE ratio is useful as a starting point for analysis, but it has to be seen in the context of other metrics and trends, such as the company's growth potential and market averages. The price-to-book ratio. One other financial statistic used to determine a firm's worth is the price-to-book ratio. To figure out a stock's price-to-book ratio, divide its current price by its book value per share. When determining a company's book value per share, total assets are divided by total liabilities and intangible assets are subtracted from both. The price-to-book ratio is a common metric for evaluating a company's worth. If the PB ratio of a firm is high, it may be overvalued, whereas if it is low, it may be undervalued. Again, the PB ratio needs to be understood in the context of the market and the company's growth potential. Discounted cash flow, or DCF. When determining whether or not an investment will be profitable, a more sophisticated method is to utilize a discounted cash flow or DCF analysis. To figure out the return on investment, you have to predict the cash flows that will come from it in the future and discount them to their current value. DCF analysis is a good way to figure out how profitable an investment will be over a long period of time because it takes time into account. Now let's have a look at the strategies for maximizing ROI. But before we do that, make sure to hit the thumbs up icon below to like this video. Here are some strategies for maximizing ROI. Diversification. Diversification involves investing in various assets to spread risk. Investing in a diverse range of assets can potentially mitigate the impact of market volatility on your portfolio. Asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset categories such as stocks, bonds, and cash. Different asset classes tend to perform differently under different market conditions, so proper asset allocation can help you balance risk and reward. Regular portfolio rebalancing. Regularly reviewing your portfolio and making adjustments to ensure it remains aligned with your investment goals and risk tolerance can help you maintain a balanced portfolio and potentially improve your long-term returns. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This can help you buy more units when prices are low and fewer when prices are high, potentially improving your overall returns. Invest for the long term. Over the long term, stocks have historically outperformed other asset classes, such as bonds and cash. By investing in a diversified portfolio of stocks and holding on to them for the long term, you may be able to achieve higher returns. Keep costs low. High fees and expenses can affect your investment returns. Look for low-cost investment options such as index funds and exchange-traded funds or ETFs to help keep your costs down. And stay informed. Stay up to date on market developments and seek advice from a financial advisor or professional if you're unsure about how to invest your money. Setting clear investment goals and having a well-defined investment plan is important because they can help you make informed investment decisions and stay focused on your long-term objectives. Having clear investment goals can help you determine the appropriate amount of risk to take and the type of investments that align with your objectives. For example, if your goal is to save for retirement, you may want to invest in a diversified portfolio of stocks, bonds, and cash. On the other hand, if your goal is to generate income in the short term, you may want to invest in more conservative assets, such as bonds or high-yield savings accounts. A well-defined investment plan can also help you stay disciplined and avoid making impulsive investment decisions based on short-term market fluctuations. It can also help you track your progress and make adjustments as needed to ensure that you're on track to achieve your goals. Setting clear investment goals and having a well-defined investment plan is important because they can help you make informed investment decisions and stay focused on your long-term financial objectives. There is a relationship between risk and return on investment. Generally, the higher the risk associated with an investment, the higher the potential return. This is because investors typically demand a higher return to compensate for taking on additional risk. For example, stocks are generally considered riskier investments than bonds because the value of stocks can fluctuate more dramatically in the short term. As a result, stocks may offer a higher potential return than bonds over the long term. However, carefully considering the level of risk associated with any investment is important. While taking on more risk may offer the potential for higher returns, it also increases the likelihood of losses. Therefore, it is important to balance the level of risk you're willing to take with your investment goals and risk tolerance. There is a relationship between risk and ROI, and it is important to carefully consider the level of risk associated with any investment to make informed decisions that align with your investment goals and risk tolerance. Take a step back and consider how your view of the strategic planning process might change. It would be great if the company's strategic planning process became an asset. When it comes to that valuable resource, how would you handle it? You'll invest enough in that strategy creation process to take full advantage of its benefits. Put money into your long-term plan in 2023, increase your return on investment, and outperform the competition. That is all for today's video. If you want timely updates from this channel about investing and money, click the bell icon and subscribe to Omega Finance. So are you ready to improve ROI for your brand in 2023? Tell us in the comment section below. We've also uploaded a video, Are Dividend Funds Right for You, on our channel, which can be very helpful to you for knowing about investment in dividend funds in 2023. You can find the link to that video in the description below and in the card.